Hey everyone, it's Daniel here from InfoRest. Hope you're all doing well. Let me be the first to say that Canada's resilient economy is actually not a really good thing. Now hold up, don't throw your eggs at me and hate on me and whatnot. If you want to do that, go ahead. I can't really stop you from doing that, but I'm behind this screen, so you'll be really throwing eggs at your computer screen. But hear me out for a second, all right? There's an article out here, and I'm going to post the link in the description for you to read up on it. But it says here, Canada's economy shows surprising strength despite rate hikes. GDP on track, 2.8% annualized growth in the first quarter. The Bank of Canada is going to find itself in a tough spot, BMO says. So going through this article, it says, Canada's economy kept growing at the start of this year, defying expectations of a stall and eventually technical recession in the face of the highest interest rates in 15 years. Preliminary data suggests gross domestic product (GDP) that measures the economy's growth and how it's doing and how many, how much products are they selling out there, expanded 0.3% in February. Statistics Canada reported Friday in Ottawa, led higher by oil and gas, manufacturing and finance and insurance sectors. That followed a 0.5% expansion in the previous month, stronger than expected for 0.4% growth in a Bloomberg survey. The Canadian economy is now on track to expand at an annualized rate of 2.8% the first quarter, assuming growth in March comes in flat. That's much more robust than 0.5% annualized pace forecast by Bank of Canada in January when it signaled a conditional rate pause, right? Remember that Bank of Canada came out and said, this is a conditional rate pause. We're pausing, but no guarantee that we're going to, pause and start cutting. We could hike rates all over again. So today's double-barreled blast of strength is well above even the most optimistic views, Bank of Montreal chief economist says, right? So let me stop here. You can read into this article and look more into it. But basically, this strength, going back to what I was saying in the beginning, this strength in the Canada's economy, GDP, is actually gives the Bank of Canada more reasons to keep things more tight, to continue with quantitative tightening, to even think about hiking rates again and pushing rates higher and higher, especially if the growth continues to be strong. Now, why would they want to do that? If the economy is doing well and the growth is doing well, why would you want to lower the growth? It's because of the inflation issue, right? If you still got a resilient market, economy is still doing well, it gives you enough room, ammunition to hike more rates because the economy can handle it, so that you can try to bring inflation down. And inflation is a big problem, not only in Canada, throughout the world. And Canada has a specific problem with housing prices. There's definitely, Canada is in a housing crisis. There's issues with supply. Prices continue to be elevated with housing, and the rates are higher, food prices are higher, everything's high, inflation's high, yet the salary is still kind of crappy and not at the same levels at how rapidly the housing prices went up and food prices as well. Definitely not at that level, 100% not at that level. So why should the Bank of Canada hike more rates? You're just going to create more pain for consumers. Well, they would do that because they're trying to bring prices down, inflation down, and they don't want inflation to run away and not be in their control. That would be a big failure for the central bank and the purpose of the central bank. Let's not forget the purpose of the central bank is to control price stability. One of the main rules, one of the main reasons why central banks were created is to control the monetary policy side of things, to control inflation. So if you've got strong growth, inflation's really elevated, you want to bring it down, then yes, it gives you more of a reason, regardless of consumers or businesses that are in pain. You do have, the government of Canada going out and giving even more money to people for the grocery bills. They launched this new program, which is going to put upward pressure, keep inflation elevated for some time, which puts the Bank of Canada in a tough situation and maybe may cause them to go back to hiking rates again, which is not a good thing, which would mean that the mortgage rates would continue to move up, and hopefully they would hope in doing that is the reason for doing that is to basically bring inflation down. So the resilience in the economy, good GDP numbers, good growth numbers in the Canadian markets and the economy is actually not a good thing, right? A lot of people will probably say it is a good thing. Sure, it is in terms of the economy, but not a good thing in terms of what could come out of it from a rate hike or a tightening or a QT point of view from the Bank of Canada. Let me know what you guys think. Leave a comment below, subscribe, hit the like button, bell icon to be notified on the next video, and I'll see you guys around. Cheers. Bye.